just dive right on into what we want to talk about today. For me, I'll give a quick bio on myself, and then I'm going to ask Reggie and Rich to do so as well. So I am Julie Verhage-Greenberg. Like I said, I am not the regulation expert here, although I am good at asking people questions. So that's why I am here. I was the co-founder of Fintech Today before joining Orum, where I run content and community. Orum is a modern payments API. Rich can give you a little bit more on that when he gives his bio as well. Reggie, tell me a little bit about yourself and how you are a regulation expert.
Yeah, so thanks everyone for joining. I'm Reggie Young, one of the product lawyers at Lithic, and super excited to be doing this with Orum. I know everyone at Lithic is huge fans of them, so excited to be presented with them. I also write the Substack Fintech Law TLDR, which focuses on fintech regulatory news. So yeah, work at Lithic. Lithic is a card issuing API for debit cards, prepaid cards, credit cards, backed by Stripe, Bessemer, Index Ventures, and others, and pride ourselves as being a fast and flexible card issuer. So I will hand it over to Rich with that.
Perfect. Thanks, Reggie and Julie. As Julie mentioned, I'm Rich DeGregoris. I also work at Orum as the Compliance and Risk Operations Manager. Prior to joining Orum, I also worked in the payment space at Bolt in a similar fashion in compliance. And just to give a little more context about what Orum really is, Orum unlocks 60-second payments with our very own single API, and we're industry agnostic. So we unlock this API 24/7, 365 days a year to facilitate your paycheck from work or payout from insurance, obtaining a loan, and various other use cases. So happy to be here and happy to discuss the regulation in this space.
Perfect. All right, let's dive right in. And reminder to anyone, as we're going through topics, if you have any questions, feel free to drop them into the Q&A. We might not get to them right away, but at the end, we've allotted some time for that. So very well could get to them later on. They don't expire or anything. So first of all, I want to talk a little bit about a regulator's point of view of fintech, because I think for a very long time, fintech was something small. I started covering fintech in 2016, 2017 when I was at Bloomberg. And I think regulators had heard of it, but they thought of it more as just things like Venmo or PayPal and stuff like that. And now, as everyone on this webinar knows, fintech is much bigger and broader than that. It definitely kept growing. And then during COVID, especially, it definitely grew quite a bit. Reggie, I'd love to get a quick lay of the land from you on what the current view from regulators is on fintech.
Yeah, I think Julie's exactly right, and that fintech was kind of a nascent industry for a while. I think the industry itself has now matured significantly, and regulators are kind of playing catch up a bit. So big thing we've been seeing, particularly in the past year and a half, is just general increased scrutiny of fintech and increased skepticism from regulators. So a big example is the CFPB, the main consumer financial regulator in the US at the federal level. They've sort of had indirect ability to regulate and supervise fintechs, but lately they've dredged up some dormant authority and called out how they specifically want to directly regulate and supervise non-banks, which is typically the legalese term you'll hear in regulatory releases that generally refers to fintechs. So the CFPB is kind of, very publicly announced intentions to directly supervise and regulate fintechs. That's been a big thing recently. There's also been a ton of OCC news. If you follow any fintech news headlines the past few weeks, you've probably seen blurbs or Twitter threads around Michael Hsu gave a speech. He's the acting head of the OCC right now. He gave this big speech that had a lot of folks in fintech worried, where he focused on fintechs pose some safety and soundness risks, which is safety and soundness generally legalese phrase for is the banking system stable? Are there going to be bank run type risks? And so it was the first time that Hsu specifically kind of really emphasized that the OCC is worried about safety and soundness risks for fintechs. There was also a big agreement with Blue Ridge, which an OCC regulated bank that partners with fintechs, and it was kind of the first big. This was, I think, 2-3 weeks ago. It was the first big consent order by a fintech partner bank that kind of lays out here's what the OCC wants for oversight programs from banks, what kind of monitoring they're doing for their fintech programs. I think one important thing to call out is a lot of the headlines around recent fintech news is focused on risks and like kind of fear mongering. But actually, if you look at in Michael Hsu's speech, his recent speech, he cites a ton of benefits, and I think that's something that gets under discussed in this recent regulatory increased scrutiny. Is like regulators often call out how fintech, helps banks access innovation and expands access to financial services. So that can often get lost. It's important to call that out.
One thing on that too, Reggie, what are things that fintech companies can do to encourage regulators to know that, yes, there are risks, but like you said, there's so many of these other benefits as well? Because I feel like oftentimes you'll see people on Twitter kind of like bashing regulators instead. And in my point of view, that kind of makes it feel worse. Like if someone's bashing me and yelling at me, I'm less inclined to see the benefits of something versus if they're having constructive conversations with me, for instance.
Yeah, I think your last comment is dead on. Like having constructive conversations with regulators, that's something we talk a bit about at Lithic, is like being proactive and getting to like build rapport with context at regulators. And like honestly, like a lot of these regulators just like want to learn about fintech, and so reaching out to, you'll see like California's financial regulator has a head of innovation who's fantastic. Like you'll see that at the federal regulator level too. These folks, like, they just want to like talk sometimes. They want to learn. Like if either Orum or Lithic were to reach out, they'd be like fascinated to like see how things work behind the scenes, and like doing that ahead of time helps helps build relationships that could come in handy later. So that's probably my biggest recommendation.
Rich, do you have anything to add here?
Yeah, I would definitely say transparency is key. So being transparent with regulators at the forward, and really just letting them know what your operations are, what your goals are, instead of a reactive sense. Proactive versus reactive is the way that fintech can move forward.
That makes sense. All right. So speaking of Rich, I want to turn to you first on this next slide that we have too. And obviously in banking, technology has always been like a small piece of it, but it just keeps getting bigger and bigger and bigger, whether it be more apps and more people interacting that way, more things happening digitally, you're not even having to go into a bank branch anymore, to a whole host of other things too, both for consumers and businesses in terms of banking. From your point of view, how has this changed how regulators are looking at fintech, and what areas are they kind of focused on here?
Yeah, absolutely. And you hit the nail on the nose. It is absolutely vast and constantly evolving. Fintech also will continue to force its inclusion into the financial sector. That's the way of the beast, and that's the future for the financial services industry. So how do they accomplish this? It's really within mobile banking, first and foremost. So in mobile banking, for example, neobank startups, technology is growing and increasingly having its hand in every aspect of banking. With that said, that's a great thing for us as consumers, because us consumers, we're starting to feel more comfortable with these walletless options, and we start to rally behind other big players like Chime, or more commonplace Google or Apple Pay for walletless payments. So with these mobile and walletless payment options now, that whole "I forgot my wallet" excuse just doesn't really cut it anymore. And mobile banking, in addition, has become the go-to method for us users to make deposits, account transfers, and monitor our spendings and earnings. And we do this all on our handheld device. So with that, I don't believe that digital-only mobile banking will ever replace brick and mortar institutions, but this is adding this pressure to the industry for, as we mentioned, to provide a more transparent customer experience.
Yeah, that makes sense. And I would also just think of, the brick and mortar. I don't go to a traditional like JP Morgan branch anymore, or Chase or Citi branch, anything like that. But if you use a challenger bank, you could still go someplace like a CVS or some other random place that has an ATM and get money out that way, or even deposit that way. So I feel like what I'm getting at is that bank branches or brick and mortar might it still be there in the future, but might look different than what it does currently as well. It could be like inside a Walmart, for instance. They're doing a big fintech thing right now. So I think that it could be evolving in that way as well.
You're absolutely right. And with that increased pressure from us consumers to banks to either change or fall behind, that's exactly where open banking was born. And open banking is really a term of providing access to financial data through technology. So how we accomplish this is really by connecting third parties to financial platforms via application programming interfaces, or as we all know them better as APIs. And we constantly hear, oh, everything an API, what is an API? So simply put, an API is a way for two or more computer programs to communicate with one another. So by definition, the opportunity is really limitless in this space. Moving forward, fintechs now are the biggest beneficiary of API technology. We utilize API technology to enable our businesses to work and facilitate the consumer experience in the financial ecosystem. So how is an API utilized? Really, for example, in a bank, an API can be utilized in a bank's mobile app to potentially pull down our information from another application. Here at Orum, we operate based on connecting our customers to payments ecosystem in real time. And of course, we accomplish that through our very own API. So we can really start to see the pattern of how data and access to data can be interconnected. And this interconnectedness, if you will, we call this the Internet of Things, which is drastically changing the way financial services operate and also the way that we utilize this data. So IoT helps companies save time and money for efficiently transferring of data. We also really help the financial institutions improve the customer experience through this IoT environment. So how do they do this? They do this by utilizing data gathered from what we call sensors to offer usage-based or behavioral-focused products. For instance, in the car insurance industry, there's a usage-based or pay-as-you-drive option, and they actually utilize these sensors to determine premiums based on your driving behavior since traveled. These sensors in this case are specifically telematics devices, but they may differ throughout the industry in financial services. And IoT in the financial services world can be utilized to update customers about offers that may best suit their needs and, of course, speed up decision making, which is a huge edge. So banks and financial institutions can really utilize this IoT environment to not only do just that for consumers, but also mitigate risks, block overtaken accounts, and even analyze suspicious activity.
Reggie, a question for you on this. On the last slide, we were talking about regulators' point of view. What about and the benefits and the risks when it comes to APIs and open banking? From someone that's just been watching from the sidelines and hasn't been in the regulatory conversations, it feels like this is something that regulators were very, very skeptical of, especially because banks were pushing back on APIs and open banking. But it feels like there's starting to be this movement where it is generally accepted. And I think in large part because consumers are demanding it for a lot of things as well. What are your thoughts on that?
Yeah, I think that's right. There's two big points here. The first is there's a rule the CFPB is working on 1033 that's going to effectively force opening of a lot of financial data that consumers have, which is like it's been something that's rolled out in a few other developed countries, and so the U.S. isn't like totally lagging behind on it, but it's something that's been on the books for a while and just not actually been implemented. So we're going to see more and more pressure on banks to open wide up. I think the other recent thing from regulators' point of view is if you look at like the recent Blue Ridge Bank consent order that I was talking about on the previous slide, they have a huge section on data controls and making sure data is stored safely. And so I think there's this general awareness within the industry and within regulators that like access to all this open data is great, but it comes with risks, right? If somebody gets if there's a breach, then suddenly if consumers' data is flowing more freely, then there's a greater risk that consumer personal information can be leaked. So I mean, Plaid has kind of done a great job with this, I think, rolling out a kind of dashboard where you can see where you signed up with Plaid and kind of shut down access. So I think we're seeing it both on the regulator front and the tech front, both becoming more mindful that like we need to think carefully about how, as data becomes increasingly open in financial services, we need to be thoughtful on how it's stored, who has access, those sorts of questions.
Yeah. On that front too, I think that on the next slide, we're talking about diversity, equity, and inclusion. And I feel like being able to more easily share data is actually a huge part of this as well, because it tends to impact those that are less served by financial institutions more than those that it's very easy for them to get a loan or open a bank account or, do all these sorts of things. Whereas someone that maybe like keeps more cash on hand, doesn't have as good of a credit score, et cetera, it's more important for them to be able to easily share this data and whatnot as well. So I'd love to dive into that aspect of it and how regulators' view on DEI is changing and how that might even be impacting the way that they're weighing the risks and the benefits as well. We can go to, perfect. Next slide here. Reggie, you want to take this one first?
Yeah, happy to. So I think there's a ton of stuff we can cite for recent regulatory pressure and like general fintech changes to promote DEI. I think one general thing I say is like I'll start with is if you look at any press release from the FTC or CFPB from the past like year and a half about, they're probably going to mention something about inclusion. Like it's clearly top of mind for the regulators, and I think that kind of comes from some of President Biden's initiatives, kind of from the top down, pushing regulators to be more thoughtful about inclusion, diversity. And so, like I say, we're seeing increased emphasis. Specific example is the CFPB has in March of this year, they had this big announcement. Well, it's kind of big. It was like big if you're in the industry, but like kind of they did it subtly, where they expanded their ability to go after discrimination. So for a little bit of background, the CFPB has this kind of general authority to go after UDAPs, unfair, deceptive acts and practices. Basically, a business doing anything sketchy. They kind of have this broad authority. And one of the things the CFPB did earlier this year is say, hey, that the unfairness part of UDAP, the U in that acronym, that includes discrimination. And it's interesting because the US has a previous law in the books that says you can't discriminate in credit, but this recent UDAP expansion touches way more than just credit, right? It's like anything financial services. So that's been a recent expansion by the CFPB, kind of bolstering their ability to go after discrimination. There's also been some attention on fair lending risks. So specifically, there's a law, the Equal Credit Opportunity Act, that was passed to target redlining, and that has gotten increased attention and emphasis from CFPB and other regulators. Or these sorts of issues have gotten increased attention. I think one good example is in May of this year, the CFPB had a press release, a circular that they put out that talked a lot about AI and machine learning as big risks, and it's something that fintech should be mindful of. Like if you can't, there's a requirement under the Equal Credit Opportunity Act where if you deny somebody credit, you have to articulate a reason for why. And the reasoning behind that is when redlining was occurring, creditors would just deny applications with no explanation, and so you can't know you're being discriminated against if you have no understanding of why you're being rejected. And so AI and machine learning pose some interesting risks that regulators are thinking about. Like if you can't, the CFPB's announcement was basically like, look, if you have a black box AI algorithm and you can't explain why somebody was denied credit, like that's a violation of law because you don't have that reason, you're required to provide it. So there's some increased scrutiny there as well. There's also some cool tech changes happening. So I think FedNow, instant payments coming to the US increasingly. Orum can speak all about instant payments. I know they're much deeper on that side of things than I am. So yeah, we're seeing increased push in the US towards instant payments, which helps some underserved groups because if it just reminded me of a founder I was talking to recently who said they were talking about this like instant like earned wage access type products, and the wealthier VCs they were trying to pitch you had a hard time understanding because like why do you need the money that you've earned ASAP once you've earned it, and they don't have that problem. And so I think with FedNow and some other instant payment developments, folks that need to get access to money like as soon as they earn it are able to do that better in a way that traditional like capital markets may not have necessarily understood. That's been a good trend. There's also a ton of like credit building cards and other products being developed now. And I also know there's a bunch of really cool reg tech companies popping up now, kind of fintech adjacent, mostly focused on fintech that will like analyze lending algorithms to try and help spot discrimination issues in algorithms before they're rolled out or anything. So
I'd be remiss to not bring up the outside of even just crypto. It feels like regulators have been, now that they're paying more attention to fintech, and fintech is this big thing, everybody wants to regulate it. And kind of, one phrase that we use in our next slide is considering fintech like the bully pulpit a little bit. And I won't name any companies specifically. You guys can do that if you want to, but it feels like no matter how big or small you are, any of the regulators can start going after you. I guess partially going back to a question that I framed earlier, and what can fintechs do to sort of avoid that situation? Give me a little bit of perspective on like why this started happening in the first place. Reggie, if you want to take this first.
Sure. Like why there's increased focus on and inclusion from regulators in the first place?
Well, and just like the way they're handling it too. Like I said, and we can go to the next slide here too, but it is sort of treating fintech like the bully pulpit a little bit rather than, the banks were the bully pulpit for a long time too, following the financial crisis. So maybe it's just swapping them out for a little bit. But how did we get to this point where regulators are treating a lot of fintech more broadly that way versus having a different mindset around it?
Yeah, I think it ties back to the conversation we were having at the beginning of this, that like fintech has matured and regulators, I think, are catching up. And that's generally some of the regulators at the federal level that President Biden has put in place are taking fairly aggressive stances at interpreting their powers and their abilities. And I think that's led to a lot of the like bully pulpit approach. Turning to this like regulatory power grabs slide, the bully pulpit is something you'll see occasionally used by regulators. It's basically this idea of like you have a podium to stand on and yell at people over and shame them, and that's definitely what the CFPB has been doing. CFPB and FTC a little bit as well. So a good example is there was a fintech in December of last year that the CFPB announced a settlement with, and they specifically called out, like in the press release, in the actual like title of the press release, the CFPB listed several of the VC funds, the notable VC funds that had invested in it, in an attempt to kind of shame them and associate them with like non-compliant fintechs. So that's something you don't see a ton of, at least like haven't prior to the current CFPB lead, Rohit Chopra. So that's kind of this broader theme of like regulatory power grabs that we're seeing, I think is a pretty key trend in the regulatory fintech world right now. So bully pulpits for sure one of those like sub themes within regulatory power grabs. I think what we were talking about earlier, the like unfair, the UDAP power that CFPB has, how they've expanded that to discrimination. That's a good example of the second point here, that regulators are expanding their ways in unprecedented and fairly unusual ways. Like 2 days ago, the Chamber of Commerce, American Bankers Association, some other trade groups sued the CFPB over this like unfairness includes discrimination power grab that the CFPB did. Because I think the big question is like the stuff can get challenged. I mentioned earlier that the CFPB and other regulators have the ability to go after discrimination and credit, thanks to the Equal Credit Opportunity Act. But this like recent CFPB news kind of expands that to like they can go after banks for giving out debit accounts in a discriminatory way, or prepaid cards. Like it's way bigger. And if you think about it, the ability to go after credit discrimination comes from a specific law, but there's no law that directly says the CFPB can go after these other things like debit. And so there's this big question of like, well, regulators like probably might need a law to have that authority. So it raises the specter of like, will this stuff stand up in court? It's great that the CFPB and other regulators are are doing all these like, unprecedented things and trying to affect change, but whether they will be challenged and actually hold up over time, I think is a different question. I'm fairly skeptical of a good amount of the stuff that's happened. So,
Rich, what do you have to add here?
Yeah, I would definitely say that regulators are really viewing fintechs because of the risk. And to a partial point, they are not wrong, right? There is increased risk because of our data sharing capabilities. We have a lot more access to data, and we're facilitating more data throughout the whole financial ecosystem. So because of that, regulators are really trying to fine tune and control the way that we share our data. And we can expect, more stringent regulation on that front moving forward. But I also do believe that, as we mentioned with the CFPB and Rohit Chopra with his dormant powers approach, and there's certain areas where I think they may be currently overstepping, but that needs to be fine-tuned over the long run. But the future is more regulation, but more fair regulation that protects the consumers, the fintechs, and the financial institutions.
I think
Yeah,
one of
go ahead.
the things I've been thinking and writing and talking about the past month in particular is like you see all this increased scrutiny because there's this idea from regulators that fintechs are potentially like unethical bad actors. But then you look at like Wells Fargo opening bank accounts, and now there's like rumors of Bank of America doing that. There's a headline of like 1.8 billion in fees to Wall Street banks over their use of WhatsApp and other messaging systems. Like it's not like fintech isn't categorically like good or bad. I think that often gets lost in these like regulatory discussions and narratives that you see in headlines.
Yeah, I think that brings it back to the point that both of you guys made earlier, and that, transparency and having conversations, even very early on, is super helpful. Just to sort of establish that relationship. It brings me back to my being a reporter days, where if I had a relationship with the company, it was just so much more likely that I understood the context that things were happening, and you just end up viewing it in a different light that way. So I think, as you both mentioned, that's very key and very important both now and moving forward, especially because it feels like there's a lot of early stage fintechs these days that might have taken that for granted a little bit as well. So speaking of, moving forward as well, my favorite slide is the next slide that we have, because I love it making people make predictions on different things. So what to expect in 2023. And there's a lot that happens at the end of 2022. We've got a bunch of elections going on, which can change a lot in DC. And it's part of the reason that things have changed a lot in the past year or two as well. So I'd love to dive into this a little bit as well. And a reminder to anyone that you can feel free to type in questions. We're allotting around like 5 to 10 minutes at the end after this slide to start asking some of those questions as well. So the first one that you guys put in here is higher bank sponsor standards for fintechs. And this, I think of a lot because I've heard of, the OCC looking at a lot of banks these days and taking, a closer look than what they might have previously. So I'd love to get your thoughts on how you think this is going to evolve in 2023. I forget which one of you put this prediction in there. You can speak to it.
Yeah, happy to chat to that. I think there's a ton we can unpack there. I think there's an interesting backdrop of maybe 4, 5, 6 months ago, I started hearing a lot of talk about how it was really hard to find credit sponsor banks. Like banks were already tightening up even before the market started tightening up. And I think they were starting to get ahead, or some banks were trying to get ahead of like the increased scrutiny they knew was coming. And so I think some of the earlier conversations we had around like Michael Shu from the OCC, his recent speech about, risks, prudential risks from fintechs, as well as the Blue Ridge Bank settlement. There's also been rumors around various other banks that are having to tighten up their standards for fintechs and even terminate relationships with fintechs for potentially like more problematic non-compliant programs. I think we're going to see more of that. I think there's implications that fintechs may see trickle down. Like banks are going to probably be choosier going forward. They're going to want to see like more. You end up with this chicken and egg problem of like a fintech needs to prove that they have some product market fit before they can go partner with a bank, but like they may need that bank to actually be able to roll the product out. And it's I think a pretty unique problem that many fintechs have to grapple with. So there's that. I think
Is that a new problem or is that more of a newer problem?
no, I think it's been a problem in fintech for a while. Like I know a lot of the payments companies that were trying to do what Stripe does before Stripe was a thing. They like grapple with this exact problem, but in a earlier form of like, oh, we don't have the infrastructure providers and they rely on like regulatory relationships, but like we can't get those relationships until we have proven that like we're actually a sophisticated company with a business. So it's a fun chicken and egg problem that keeps us lawyers employed. So I'm happy with it. But no, I think you're going to see some implications. Like I think banks are going to be choosier. They may become more expensive to partner with. Like I think sponsor bank fees might go up. The banks themselves are going to increase scrutiny. So fintechs may have to like hire additional headcount or just spend more time on their compliance team dealing with questions and inquiries and oversight from their bank partner. Banks can have increased costs and like most likely pass those compliance costs on to fintechs in some instances. So lot that could happen there. We'll see.
Topic number 2, taking a little bit of a shift here. Rich, I believe this was yours, but you think there's going to be more crypto and DeFi projects, but we're still going to see minimal laws and regulations happening in 2023. Elaborate a bit.
Perfect. Yeah. So you mentioned a hot topic of recent years has definitely been cryptocurrency and decentralized finance, or as you can see, DeFi, better as we know it. Specifically, what is DeFi? DeFi is a crypto-based financial network without a central intermediary. So this actually offers the potential of delivering more innovative, inclusive, and transparent financial services. But technically speaking, DeFi projects are software protocols running on top of a blockchain network. And these blockchain networks can be Ethereum, Cosmos, Solana, and various other networks. Now, currently, there's hundreds, if not thousands of projects implemented and underway in DeFi. And they range in topics. They focus on alternative savings, lending and borrowing, stablecoin issuance, and staking and yielding, just to name a few. So what can we expect in 2023 with regards to this whole area? We can absolutely expect more stringent regulation on the specificity of interest-bearing accounts versus staking or rewards on these various different networks. And we can point to the BlockFi settlement in this recent year, where the SEC determined that their rewards program that they offered is actually considered interest-bearing accounts and that have major tax implications. So they were required for quite a large settlement, I believe, of $100 million or more. So I think that is a priority right now of regulators, is to fine tune that specific piece and then focus more on the lending and borrowing aspects of decentralized finance. And I think that will be the first 2 steps in really fine tuning our regulation within this space.
That makes sense. Now, the third prediction here, apply policy to both banks and fintechs. This is something that you feel like would have happened a while ago. Like if you're acting like a bank, you're regulated a bit like a bank. If you're putting more tech into your bank, you're regulated like a fintech would be, etc. Reggie, dive into this one a little bit. This was one of your predictions.
Yeah, I'll definitely start this one off. And I think a big issue right now is that regulators are trying to regulate fintechs in the same vein as banks. And because there's an absence of governing entities in fintechs, really provides this challenge for effective regulation. And we really should not be regulated in that same vein as banks. So what should be the goal of regulators? The goal really should be a balance that supports not only fintech's benefits, but also minimizes the risk to the potential risks, to the financial system. So what we would want as fintechs are proportional policies that align needs additional banks and banking institutions. So an example of this would be necessarily for neobanks, stronger defined capital, liquidity, or risk management requirements. Moving forward into DeFi, we would want regulation focused on, as I mentioned, those interest-bearing and staking accounts, We also would want these stablecoin issuers to be further regulated, as that is one of the major accelerations of growth in the decentralized finance space. And there was also a big crash of the algorithmic stablecoins this past year with Luna that really shaked up the trust in the stability of these stablecoins that are tied to the dollar or the euro, if you will. So we can expect regulators like the OCC and CFPB to dictate or propose robust governance, potentially including industry codes or self-regulatory organizations on these cryptocurrency exchanges and fintechs alike. But we also shouldn't be surprised to see the US propose much more regulation on fintechs in 2023, in a similar vein to how the EU has already accomplished this. And we can see that the political shift, after the midterm elections really may also have a hand in the advent of more regulation on fintech.
And finally, Reggie, this one was yours. Potential political shifts after the November midterms. And this is something that I feel like earlier on, it might have been easier to predict, but given the past few elections and how close and how different things have been than what people were anticipating going into it based on polling and whatnot, I feel like, you're earning your pay a little bit more now with how hard it is to predict what actually is going to happen.
Yeah, super hard to say. I think there's a lot of interesting commentary around what the outcome of the midterms will be. So I won't speak too closely to that, but I think there's potential that one of the two pieces of Congress flips. If the Senate flips, flips majority Republican, it can create a lot of friction for the more progressive regulators that are currently in. I think the best example, the regulators know this, and I think the best example is the CFPB. I think 2 months ago at this point, they created a new office solely for responding to congressional inquiries with the expectation that Republicans may take, for example, the Senate. And what happens in that case is then Republicans will be able to better set, will be able to set where the financial committee focuses its attention on. And that's where you see I think it was this past week, the CEOs of big banks were dragged in for a panel. It's that kind of stuff where the committees will be able to focus on hey, regulators doing too much, or this industry is too regulated, and help slow down and divert resources from stuff, for example, that the CFPB is otherwise trying to champion. So potential political shift after the midterms could slow down a lot of the momentum and the kind of more aggressive or unprecedented tactics that fintech regulators have been taking this past year and a half.
Could be interesting. So for the Q&A portion, let's get that started. We've got around 5 to 10 minutes that we can ask some questions here too. And feel free to drop more questions in the chat as we're going. I wanted to start off with something that surprisingly we haven't really talked about too much, although I guess we have talked about lending. So it's in there that way. But what do we think is going to happen around buy now, pay later regulation? Because this is something that I feel like was a hot topic for a while, then kind of cooled off a little bit, and now is picking up steam a bit again.
Yeah, I'm happy to share my 2 cents. I think the general theme, if you read anything the CFPB has put out around buy now, pay later, is they're very much in favor of treating it like a loan and treating it like credit and regulating it like credit. And so that's ideally where regulators, I think, want to take it. You also see this California has been going after buy now, pay later companies and making them get a lending license. So I think we're going to see that trend continue. I think there'll still be kind of I guess you could call it a safe harbor for simpler buy now, pay later products. And for context, under federal law, you don't really trigger the main credit law if you're collecting in 4 or fewer installments, which helps explain why buy now, pay later companies started with the 4 or fewer installment product. So I think you'll still see some kind of 2 paths: one, a more lightly regulated buy now, pay later, and then a more scrutinized, treated like loan buy now, pay later approach.
Rich, you have anything to add there?
Yeah, I definitely agree with the approach to buy now, pay later with what Reggie is discussing. And I also think that regulators can are really focused on that peer-to-peer payments world as well, with, tax implications on, believe it's over $600 and typical Venmo, Zelle, or any other transactions from peers to peers. So I think that is a place where regulators are going to focus in the coming year. They already have implemented some regulation on that, and they're going to try to fine tune that, although it's a difficult space to operate on because we know we use peer-to-peer payments for everyday items, even between, spouse and families. So it's very difficult to tax and really align as to what these payments are being utilized for.
Well, we have a good question in the Q&A too, Reggie, if you want to take that.
Yeah, for sure. This is a great question. So question effectively asks, are there certain models of fintech bank partnerships that are likely to be subject to more scrutiny and considered more problematic by regulators? Yeah, I think there are. I think lending generally gets more scrutiny than other programs, like neobank or debit card program is probably going to be subject to less scrutiny than like a payday lending program, for example. So that's a big one. I think crypto, it's interesting. The OCC speech that we touched on earlier in the slide, the Michael Hsu specifically said that he actually thinks fintechs pose bigger risk to safety and soundness in the banking system than crypto, which was a kind of odd comment if you think about all the headlines recently. But I think he's like generally, if you're thinking about it from a bank risk perspective, that's probably right. I think the bigger risk with crypto is like potentially, fraudulent ICOs and those sorts of issues, which is more like SEC kind of securities type stuff. But so I think I think lending generally, I think crypto, those are probably the bigger ones I'd flag as fintech models that'll be subject to more scrutiny than others.
The next question, I love the optimism in here. I wish it wasn't an anonymous question. Why is fintech the future? Rich, you want to take this?
Sure. Well, I definitely believe fintech to be the future. As we know, I do work at one. But fintechs really together with handheld devices brings financial services even to the most remote parts of the world that don't have access to traditional banking institutions. So that in and of itself is just a huge value add for accessibility and inclusivity for tens of millions of people throughout the world. And they may be accessing their first banking, lending, payments, financial products, so to speak. This doesn't only relate to individuals. This also can be small and medium businesses throughout the world that are getting kickstarted but need access to financial products. These small and medium businesses will be absolutely largely assisted by fintechs, and it will be easier than ever to open a bank account or get a loan without having to walk into a traditional banking institution.
It makes sense. That makes sense. One of you guys want to take this? We have time for this one more question. Do you guys want to take this last one or have me read it off?
Sure. Yeah, I'll grab it. What are some keys for a fintech startup when trying to navigate the regulatory landscape? Well, this is a great question. I'm sure I was very curious on this when I started my career. And still, it's a forever evolving landscape. But I would really put this in 3 buckets, okay? So from a compliance and risk standpoint, first and foremost, as we mentioned earlier in the call, is data. Data privacy, data security, and data management. That's the most paramount facet in the fintech industry to really tackle. And we need to make sure that we have safeguards, access capabilities taken on, and really make sure that the sharing of our data is aligned. We have encryption in there, and we have the tech stack that can support the data as well. Outside of the data world, we want to ensure that we have adequate KYC on all customers and end users. Now, the AML regulation there are global AML regulations that tie to the EU that are already implemented on fintechs. And right now, we actually do fall out of the AML regulation by the standard of a financial institution. However, when you make a partnership with these sponsored banks, you will enter their programs. And a lot of times AML is one of the larger risks in this space. So being proactive and getting a KYC program in place will only assist you and the risk posed to your institution. And then also, if your fintech has global operations or global aspirations, there are much more stringent already implemented throughout the world, as I mentioned, especially in the EU. So you want to make sure when you're building up your fintech's product, your tech stack, and your program that you're taking into account these global regulations, not just the US regulations.
All right, one more question. Reggie, you take your pick.
I think we've got a good question on how prepared and ready is the OCC to put action behind its rhetoric. I know there's some folks who like haven't seen that. I know like at Lithic, we were kind of scratching our heads when a lot of the news, regulatory news came out, because we also haven't seen that. And I think they are ready to throw action behind it. I think Blue Ridge is actually a good example of this. Like I forget how many pages. It's like a consent order that is very detailed. Blue Ridge, one of their fintech partners, shut down surprisingly a week before this Blue Ridge settlement came out. Like, I think there is some muscle the OCC can throw around. I don't think it's hitting most fintechs yet, but it is like a good thing to be prepared for. I think a great exercise is to kind of look at that Blue Ridge agreement. For the great exercise for compliance and legal teams at fintechs is to look at that Blue Ridge consent order and say like, hey, are these things we are prepared to have an answer for? And if not, might be something you want to have some internal conversations around. Yeah, to the question, I think fortunately there's not too much heat coming down from the OCC, but to the point I was making earlier, like there are good fintechs, just like there are good banks. There are also like less compliant fintechs, just like there are less compliant banks. Like it kind of, I think, depends on the company. So it's hard to. I don't want folks to rely too much on the idea that like the OCC is or isn't, increasing scrutiny. Their CFP is or isn't doing things. I think it's a highly company dependent circumstance.
On that note, thank you to everyone that joined us for today's webinar, whether live or you're going to watch this on demand when we send it out tomorrow. And thank you to both Rich and Reggie. I learned a lot. It sounds like other people, based on the questions and in the chat, learned quite a bit. But if you have any other questions that we didn't get to, I know there were a couple that got left there. The contact information for Reggie and Rich is on there. And then they also listed some additional resources. And again, we'll be sending out both the presentation as well as the recording. So don't feel like you need to write this down immediately. You will get it tomorrow. But thank you so much for joining us, you guys. I really appreciate it. This was great.
Thanks so much, Julie. And thank you all for joining.
Yeah, thanks everyone for joining. This is great.
Awesome. And if you need to learn anything else about Lithic or Orum, go to our websites. Again, find out more about the payment space, what's going on in regulation, all that kind of stuff. Otherwise, we will see you guys next time. Thank you.